Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at HIMS and HERS Health.
If you find our talks useful, please consider subscribe, like, and comment underneath. We really appreciate the support.
We really do.
So getting right into it today, looking at the market lately, it honestly feels a bit like we're living in two completely different realities.
Oh, absolutely.
Right. You have these AI darlings trading at valuations that just make your nose bleed. They are priced for absolute perfection. And then you stumble across a setup like the one we are breaking down today, and it stops you in your tracks. It feels like a total paradox.
It really is one of the most confusing and frankly fascinating setups we've seen in a long time. We are talking about HIMS and HERS Health today. And if you've been following the financial headlines at all recently, you know this has become a complete battleground stock.
Battleground is putting it lightly. I mean, it's more like a crime scene if you look at the chart. So let's unpack this for you listening. On one side, you have a company that just delivered what I would frankly call massive growth numbers. I mean, the kind of growth that usually sends a stock straight to the moon.
Exactly. The kind of print that gets investors really excited.
Yeah, but if you look at the ticker, it's a disaster. It's trading near multi-year lows right now. So for anyone tuning in who might be, holding the bag right now, or maybe you're on the sidelines thinking, is this a bargain or is this a value trap? What on earth is actually going on here?
To really understand the disconnect, we have to start with the hard data. We have to look at the price versus the actual operational performance. So right now, HIMS and HERS is trading around $15.46. Now, in a vacuum, that price means nothing, right? But here is the context. The stock is down 53% just year to date in 2026.
Wait, hold on. We are only in February right now. It's down over 50% in 2 months.
Correct. 2 months. And if you zoom out a little further, it's down 69% over the past 12 months. Basically, if you bought a year ago, you've lost nearly 70% of your initial investment.
Wow. That is just ugly. I mean, usually when I see a stock down 70% in a year, I automatically assume the business is completely broken. I assume they're losing customers in droves, the core product is failing, or they're just burning cash and running out of runway. That's usually the signal a market is sending with a drop like that.
You would think so. That is the rational textbook assumption. But here's the flip side, and this is where that paradox we mentioned really kicks in. For the full year of 2025, their revenue came in at $2.35 billion.
Okay.
That is a 59% increase year over year.
Okay, let me just process that for a second. The stock price has been cut in half, well, more than half, really. But the actual money coming into the business, the top-line revenue, grew by nearly 60%.
Precisely. The business is nearly twice the size it was a year ago, but the market is valuing it at a mere fraction of what it used to.
That's the definition of a disconnect. So the core question we have to answer today is pretty simple. If the company is nearly doubling its business size, why is the broader market punishing the stock so severely? Is this actually a broken business under the hood, or are we looking at a classic capitulation bottom where the market has just collectively lost its mind?
To answer that, we can't just look at the top-line revenue growth. We have to look under the hood at the financial fundamentals. They just released their earnings for Q4 and the full year of 2025. Now, Q4 revenue was $617.8 million. That's up 28.4% from the exact same time the previous year.
Okay, so nearly 30% growth in a single quarter. It's not the hypergrowth of the full-year average. That's still very solid double-digit expansion. It certainly does sound like a company that's dying.
It definitely isn't. Net income for the year was $128 million. But the number the bulls are really focusing on, and the number that really matters for a growth company at this stage of its life cycle, is adjusted EBITDA. That came in at a very strong $318 million.
Let's pause there for a second. We hear adjusted EBITDA thrown around a lot in earnings calls. For you listening who might be a bit skeptical of adjusted numbers, because sometimes that just feels like a fancy way of saying earnings before bad stuff, why does that metric matter specifically for this company right now?
That's a very fair skepticism to have. Adjusted EBITDA stands for earnings before interest, taxes, depreciation, and amortization. In high-growth telehealth or tech platforms, it is often the most accurate proxy for the raw cash-generating power of the business model itself. It shows the cash flow before you account for complex accounting write-offs or massive one-time tax events.
Right, it strips out the noise.
Exactly. So a huge EBITDA number like $318 million tells us the core machine is highly profitable. It works. It generates real cash.
Okay, so the core engine is working. But I was reading through the report earlier, and there's a bit of a red flag that the bears are really latching onto. The margins contracted, right? And that's usually the death knell for a growth stock in this current macro environment.
That is exactly the sticking point for Wall Street right now. Net margin dropped from 8.5% down to 5.5%. And if you look at earnings per share, or EPS, in Q4, it dropped to 9 cents compared to 12 cents the previous year.
See, that right there is what scares investors away. You see the top line going up, but the actual profitability per share is going down. It suggests that maybe they're having to spend way too much money just to acquire those new customers.
Yeah.
Is that what's happening here? Is the business model getting less efficient at scale?
This is where context is absolutely everything. If you just look at the headline number on a stock screener, yeah, it looks like an operational failure. It looks like they're just burning cash to buy growth. But if you dig into the actual expense lines, it's deliberate reinvestment. They aren't losing money because they're inefficient. They're purposefully shrinking their margin because they are spending heavily on customer acquisition and massive product expansion.
So they're taking the cash they generate and pouring it right back into the engine to grow even faster.
Exactly. They were playing offense in a major way. And the biggest chunk of that spending, the specific thing really weighing down the EPS right now, is their massive acquisition of eucalyptus. We are talking about a $1.15 billion deal.
Whoa, over $1 billion. That is a massive, massive bet for a company of this size.
It is huge. And naturally, when you make a strategic move that big, your short-term margins are absolutely going to take a hit. There are integration costs, heavy legal fees, complicated accounting adjustments. But I would argue that this temporary dip in EPS completely masks the underlying cash generation strength that we saw with that $318 million in EBITDA.
Let's talk about that acquisition for a minute. Spending over $1 billion on eucalyptus. For people who don't know the landscape, what exactly is eucalyptus, and why does HIMS and HERS need to buy it right now?
It's a very calculated strategic pivot. Eucalyptus is essentially the HIMS and HERS of international markets. They have a particularly strong foothold in Australia and the UK. Until now, HIMS and HERS has been largely a US-centric story and largely a story about hair loss and, more recently, weight loss drugs.
Right, the famous GLP-1s, the Ozempics and Wegovy's of the world. Everyone is talking about them.
Exactly, and relying heavily on one geographic market and one really hot drug category creates immense concentration risk. Buying eucalyptus completely diversifies their revenue beyond just the U.S. telehealth market. It opens up entirely new regulatory territories. But more importantly, it reduces their overall reliance on specific drug categories like GLP-1s. It's about building a much broader global platform so they aren't just seen as a one-trick pony.
So it's a defensive move just as much as an offensive one. They are buying diversification to protect themselves from U.S. regulatory changes or shifts in domestic consumer trends.
Spot on. And they are buying a massive moat. Think about their current subscriber base. Right now, they have 2.5 million active subscribers. That is up 13% year over year.
2.5 million people paying a recurring subscription. That's not an insignificant number. That's a lot of recurring credit card charges hitting every month.
Massive scale. And what's fascinating here is the underlying switching costs. When you are a subscriber on a platform like this, you have your health records fully integrated, you have an established relationship with a specific healthcare provider, and you have ongoing automated prescriptions showing up at your door. It's not like switching a brand of shampoo at the grocery store.
Right. You can just pick up a different bottle off the shelf if you're annoyed.
Yeah.
You'd have to go find a new doctor, book a consultation, get a whole new script written, input all your medical history again.
Exactly. It's a huge hassle to leave. That creates a level of stickiness that the broader market might be severely undervaluing right now. The lifetime value of that customer is potentially much higher than analysts realize because once you get them into the ecosystem, they tend to just stay.
Okay, so we have really strong revenue growth, a highly sticky user base, and $1 billion acquisition to secure the international future. But we really can't ignore the elephant in the room here. The reason the stock is sitting down at $15 isn't just because of some short-term margin compression. It's the headlines, it's the regulation, it's the fear.
You're absolutely right. The narrative around HIMS and HERS for the last few quarters has been completely dominated by fear regarding those weight loss drugs.
Specifically the compounded GLP-1s, right? The off-brand Ozempic, essentially, that they were prescribing.
Correct. There are two main headwinds that have absolutely terrified retail and institutional investors alike. First, there is an active SEC investigation into their specific disclosures regarding these compounded weight loss medications. Whenever you see the words SEC investigation in a financial headline, investors just run for the exits.
It's the kiss of death for momentum. Nobody wants to be holding the bag if the government steps in and shuts operations down.
Exactly. And second, there is a major patent infringement lawsuit from Novo Nordisk, the actual maker of Ozempic and Wegovy, regarding compounded semaglutide. So you have the federal government looking closely at your paperwork, and you have big pharma aggressively coming after your core product line.
That sounds pretty terrifying, to be honest. I mean, why shouldn't we be terrified by that? That sounds like an existential threat to the business.
Because the stock market is ultimately a forward-looking mechanism, and if you look closely, these are yesterday's problems.
How so? Walk me through that.
First off, HIMS and HERS has actually already withdrawn its compounded semaglutide product from the market.
Oh, they fully pull it.
Yes. They saw the writing on the wall and rapidly pivoted to offering branded alternatives instead. So that massive lawsuit from Novo Nordisk, it's basically fighting a battle over a product that isn't even the future of the company anymore. The existential risk is essentially capped because management has already made the move to mitigate it.
So they just took the hit, absorbed the change, and moved on. That shows some serious operational agility.
Exactly. And look at what management is actively saying about the future in this recent earnings call. They explicitly stated that they expect year-on-year growth in 2026 for both their weight loss and their non-weight loss businesses.
Wait, so even without the cheap compounded stuff, they still expect to significantly grow the weight loss segment this year?
Yes, they do. Which tells you something really important. The consumer demand is for the platform itself and the frictionless access to care, not just for a specific cheap compounded pill. The bear case in the market thinks the whole business model breaks without compounded semaglutide. The internal data suggests otherwise.
That is a crucial distinction for anyone trying to build wealth here. The bear case is basically they are a sketchy compounding pharmacy skirting the rules. But the bull case is they are a legitimate digital hospital front door.
That's a fantastic way to put it. And if you genuinely believe the bull case, then the current stock price is reflecting a disaster scenario that simply isn't playing out in reality.
So let's look forward then. We are sitting in early 2026 right now. What does the rest of this year actually look like? Because if the stock is going to recover from this 69% drop, the numbers really have to back it up over the next few quarters.
Management has given us some pretty clear and confident forward guidance. For the full fiscal year of 2026, they are projecting revenue between $2.7 and $2.9 billion.
So we're looking at another 15 to 23% growth on top of the massive growth they just delivered.
Correct. And for adjusted EBITDA, they are guiding for a range of $300 to $375 million. But here is the critical nuance, and this is where it gets really interesting for anyone trying to time an entry into this stock.
Okay, lay it on me. What's the catch?
Management specifically flagged a meaningful sequential ramp throughout the year.
Meaningful sequential ramp. That's prime corporate speak for it starts slow and gets fast later, right?
Exactly. If you look closely at the Q1 2026 guidance, they are calling for $625 million in revenue. That directly implies that the beginning of the year is going to be steady but modest, but the back half of the year is where the real fireworks are going to happen.
Yeah, it actually makes perfect sense. I mean, they are integrating eucalyptus. They're actively shifting thousands of customers from compounded drugs to branded drugs. That transition takes a minute to smooth out.
Right. So the setup here is that the operational metrics will look better and better as the year progresses. This perfectly positions the stock for potential positive earnings surprises in Q3 and Q4. The bar is set relatively low for the start of the year, but the momentum is quietly building beneath the surface.
So if you're an investor looking at this, you're looking at a company that is essentially telling you, hey, we're going to accelerate as the months go on. Now let's talk valuation, because at the end of the day, we are here to figure out the wealth building angle. Is this stock genuinely on sale right now, or is it just a classic value trap?
When you look at the technical setup alongside the valuation metrics, it screams asymmetry.
Asymmetry meaning the potential upside is just significantly larger than the remaining downside risk.
Yes, exactly. The violent drop to around $15 looks like classic market capitulation. Capitulation is when the weak hands the retail investors who just can't stomach the intense volatility or the scary SEC headlines anymore, finally sell out at a massive loss. They just give up and walk away.
And historically, that kind of volume selling usually marks the absolute bottom for a stock.
Very often, yes. And there is another massive technical factor at play here, short interest. The short interest on this ticker is at its highest level in at least a year.
So a lot of institutional money is actively betting against it going up.
A huge amount. But think about what we just discussed for the last 10 minutes. Revenue is still growing rapidly. Cash flow margins are stabilizing despite a billion-dollar acquisition. The regulatory risk from the SEC and Novo Nordisk is largely in the rearview mirror because of their product pivot. If literally any good news hits the wire, a slight earnings beat next quarter, or a positive update on the eucalyptus integration, those short sellers are going to be forced to cover their positions.
And that forced buying triggers a massive short squeeze.
Boom. You get a rapid, violent spike in the share price. Now, looking at what the Wall Street pros actually think the current analyst consensus target is $20.19, that represents a 31% upside from where we are trading right now.
31% is a very healthy gain for a single year.
And keep in mind, that's just the middle-of-the-road consensus. If you look at a discounted cash flow analysis, or DCF, which is a model that tries to calculate the true intrinsic value of the company based on its future cash flows, some of those estimates go as high as $64.89. $64? That's more than a 4x return from current levels.
It sounds aggressively high, I know. But remember, this is a company already generating over $300 million in real cash EBITDA with a very clear guided path to nearly $3 billion in annual revenue. The market has currently priced it as if it's going out of business next month because of the SEC. If it doesn't go out of business, which the fundamental cash flow clearly suggests it won't, the upward repricing could be violent.
It really does seem like the market as a whole hates uncertainty way more than it hates actual bad news. And right now, the uncertainty around the GLP-1 pivot is high, so the stock price is punished.
That's the golden rule of investing, isn't it? You pay a high premium price for certainty. You get a massive bargain when there is uncertainty in the air. The real question you have to ask is whether that uncertainty is actually justified. In this specific case, with the eucalyptus deal closed and the margin stabilization plan laid out, the company seems to have a very clear, actionable roadmap out of the woods. So let's wrap this up for you listening today. We've covered a lot of ground here. The paradox of massive growth versus a crashing price, the hidden profitability in the EBITDA numbers, the massive international acquisition, and the reality of the bear case. If you had to summarize this into a quick elevator pitch for someone looking at their portfolio right now, what is the actual play here?
The elevator pitch is essentially this. HIMS and HERS is a high-growth, cash-generating platform currently trading at a deep, deep discount due to temporary regulatory headwinds. The broader market is completely obsessing over short-term margin compression and legal headlines that are already fading into the background. Meanwhile, the actual company has used that exact same time to buy a massive international growth engine in eucalyptus and quietly stabilize its core U.S. business.
And regarding actual timeframes, because we always have active swing traders and we have long-term buy and hold investors listening to this, how should they approach it?
I see two very distinct tactical opportunities here. First, there is the swing trade approach. You could look to build a position heading into the Q1 2026 earnings, which will be coming up in April or May. You're basically looking for a quick 20 to 30% bounce as the company officially proves to the market that the sky isn't falling and the GLP-1 pivot worked.
Right, a quick momentum play based purely on sentiment shifting from extreme fear to neutral.
Exactly. Get in, get the re-rating, get out. But then there is the multi-year hold strategy. This is for the 12 to 24-month horizon. In this scenario, you're aggressively accumulating shares while they're beaten down here below $16, and you're targeting a fundamental move back up to $30 or $40 per share.
Effectively doubling your money over a couple of years.
Yes. That longer-term thesis relies on the international eucalyptus strategy really paying off, and the market finally realizing that HIMS and HERS is way more than just a pandemic-era GLP-1 stock. As the core margins inevitably expand in late 2026 and 2027, the stock's multiple should re-rate significantly higher.
It's an incredibly compelling case. It really highlights the classic Warren Buffett difference between price and value. The price is what you pay on the ticker today, but value is what you actually get. And right now, the price is artificially low. but the value, that massive recurring revenue, that sticky subscriber base, is just growing quarter after quarter.
It really is. And one final thing to deeply consider regarding that moat we discussed earlier. In today's digital healthcare world, owning the direct customer relationship is absolutely everything. Hims and Hers completely owns the daily relationship with 2.5 million people regarding their most personal, sensitive health issues. That data, that habit, and that immense consumer trust is incredibly hard for a competitor to replicate. The market is completely ignoring that massive intangible asset right now because analysts are too focused on reading legal briefs.
That is such a profound point. And it raises the final question for you to consider today as you look at your own portfolio. When the market panics over short-term margins, while a company is actively capturing massive market share and buying its way into lucrative new global markets, do you see a falling knife that you should avoid at all costs? Or do you see a rare asymmetric window to buy premium growth at deep value prices?
That really is the question that defines successful wealth building.
Thanks for tuning into Smart Wealth with Joshua. Make sure to do your own research, and we'll catch you in the next one.